Hello and welcome to This Explainer. I am absolutely thrilled to have you here today. Look, if you're a focused learner who just wants to understand the actual mechanics of the crypto market without all the fluff, you are in exactly the right place. Today, we're tackling a massive topic. We're going to master crypto futures, unpack the incredible power of leverage, and most importantly, we're going to lock down the absolute survival rules of risk management. We're pulling all our insights today from an intensive crypto trading course breakdown, and we're going to visually dissect exactly how modern trading works step by step. So get comfortable, get focused, and let's decode the mechanics of trading safely.
Okay, let's dive into this. Here's our roadmap for today. First, we'll look at the move to futures. Second, the power of leverage. Third, the trap of liquidation. And finally, we'll cover proper risk management. Let's get going.
Section 1. The move to futures. Understanding the shift from spot to derivative trading.
So to truly understand how to trade, we first have to figure out why the trading landscape is shifting so dramatically right now. I mean, why are traders choosing crypto futures over everything else? It's becoming a massive trend. Think about traditional stock markets for a second. They are heavily restricted, they usually open around 9:15 a.m. and close up by 3:30 p.m. Honestly, if you have a day job or if you're a full-time student, those hours just don't work for you. Plus, traditional intraday trading often limits your leverage to a mere 5 times your capital. Crypto, on the other hand, is a 24/7 market. But that still doesn't totally explain why traders are choosing crypto futures specifically rather than just buying and holding regular crypto assets. Well, the answer comes down to exactly 30%. To put that in perspective, in places like India, the government considers crypto a digital asset and slaps a staggering 30% tax on spot trading profits. And here's the real kicker. If you take a loss, you literally cannot set it off against your profits. So if you make 10,000 rupees today, you owe 3,000 in tax. If you lose all your money the very next day, nobody cares. You still owe that tax on yesterday's profit. Throw in a 1% TDS on transactions, and this harsh reality basically drove active traders completely away from spot trading. But derivative contracts, like futures, operate entirely differently. Because you're trading a contract and not actually taking delivery of the underlying asset, traders use futures as a totally legal alternative to navigate around that brutal 30% spot tax hurdle. It just makes it a far more viable landscape for active daily trading. So, now that traders have flocked to the futures market, what's the main tool they're using? Section 2. The power of leverage. Amplifying your market exposure.
Let's define it. Leverage is, at its core, borrowed funds provided by a broker, or in our case, a crypto exchange, to increase the size of your trading position way beyond what your actual cash balance would normally allow. Think of it like a giant financial magnifying glass. If you don't have a massive amount of capital to start with, the exchange essentially steps in and says, hey, put down your small amount of cash and we will lend you the rest so you can make a really big trade.
And this brilliantly illustrates the sheer scale we're talking about here. Just look at this comparison. On the left side, if you trade with zero leverage, just your standard 1x, your 1,000 rupees gives you exactly 1,000 rupees in market exposure. If the market goes up 1%, you make a grand total of 10 rupees. Not exactly life-changing, right? But look over on the right side. In crypto futures, exchanges often offer up to an insane 200x leverage. That exact same 1,000 rupees suddenly transforms into 200,000 rupees of market exposure. You're quite literally wielding the power of a much larger trader, but using the exact same initial capital. Let's actually walk through the math step by step because it's genuinely fascinating. Step 1, you invest just 1,000 rupees out of your own pocket. Step 2, you apply that absolute maximum 200x leverage, giving you command over a 200,000 rupee position. Step 3, let's say the market experiences a pretty standard crypto move and rises by just 5%. Well, 5% of your 200,000 rupee exposure is 10,000 rupees. Step 4, you walk away with 10,000 rupees in pure profit. You literally just made 10 times your initial capital on a tiny 5% market swing. It's wild. This incredible upside is exactly why the futures market acts like a magnet for traders worldwide. But as we all know, where there is extreme upside, there's equally extreme danger. So it's time to flip the coin and look at the severe risk attached to all those borrowed funds. Section 3. The trap of liquidation. The severe risk of borrowed funds. So here's the million-dollar question. What happens if the market drops by just 0.5%? We just saw that a 5% gain could make you rich. But remember, you have a 2 lakh rupee position, and 199,000 of that actually belongs to the exchange. If the market drops by half of a single percent, the total value of your position drops by 1,000 rupees. And unfortunately, that happens to be the exact amount of your initial capital. and that triggers immediate liquidation. Liquidation is the automatic forced closure of your position by the exchange. Why do they do this? Because the exchange will never ever take a loss on the money they lent you. The very moment your trade loses 1,000 rupees, your entire initial capital is wiped out. The exchange immediately steps in, shuts down your trade entirely, takes back their 199,000 rupees to protect themselves, and you are left with absolutely zero. A microscopic 0.5% market dip is literally all it takes to completely destroy your position when you max out your leverage. Our source material has this fantastic analogy. If used incorrectly, leverage can act like a reverse knife. Think about it. If you hold a knife by the handle, it's an incredibly useful tool that cuts perfectly. But if you try to hold it by the blade, it's going to severely injure you. Treating 200x leverage as some sort of get-rich-quick scheme, that is absolutely holding the knife by the blade. Yes, your risk is technically capped at the money you put in. You won't end up owing the broker extra money, but you will lose 100% of your invested capital in the blink of an eye. So how do we actually survive this? How do we use the knife correctly? Well, understanding liquidation is the absolute foundation for building a mathematical, highly disciplined approach to trading.
Section 4. Proper risk management. Rules for surviving the crypto market. Okay, here are the strict survival rules derived straight from our source. First up, your capital base. Don't just throw in 100 rupees and treat it like a casino. Build a solid base of 15,000 to 20,000 rupees. Why? Because this actually allows you to size your positions correctly without risking your entire portfolio on one single trade. Second, the leverage limit. You need to drop that 200x fantasy right now. Stick to a maximum of 20x or maybe 25x. Lower leverage means your liquidation price is pushed much, much further away from the current market price, giving your trade the actual room it needs to breathe. And third, trade liquid pairs only. Stick to massive, highly liquid assets. We're talking Bitcoin, Ethereum, Solana. Small, unknown meme coins are easily manipulated and highly prone to sudden, sharp crashes that will instantly trigger your liquidation.
Now, what's really interesting here is that time is actually a massive factor in risk management. Yes, we know crypto is 24/7, but not all hours are created equal. 9:15 a.m. is when traditional Indian stock markets open. But for crypto, the real action starts a bit later. By 12:30 p.m., the London session begins, and that brings a massive influx of liquidity and stability to the market. Then, by 7 p.m., the U.S. session kicks in, offering absolute peak volume and volatility. Trading during these specific high liquidity windows is a crucial risk management tool. Why? Because high volume drastically reduces the chances of artificial market manipulation and those sudden, unexplainable price spikes that just completely wipe out leveraged traders.
As we wrap up this explainer, I want to leave you with a pretty provocative question. Will you let leverage be your greatest tool or your ultimate trap? The mechanics of futures trading offer unparalleled freedom and the potential for exponential gains, but they demand absolute psychological discipline. At the end of the day, it's a game of mathematics, not emotion. If you master the math of liquidation and respect the strict boundaries of risk management, the market becomes a phenomenal tool of opportunity rather than a casino of ruin. Thank you so much for joining me on this deep dive, and as always, keep learning.